So how do you ramp up your retirement through real estate? In this video, I'm going to show you some incredible things that most people don't understand. I'm telling you, if the United States really took retirement serious, I think that they would make everybody take a one-year course on how our retirement system works in the United States. And everybody, once you understand it, because there's so much mystery around it, that I think people get confused and they just give up. And we've all heard the term, don't look at your statements because we're in it for the long haul. I mean, there's nothing to be further from the truth on this. So what I'm going to do in this video, I'm going to walk you step by step on how to take real estate and literally turbocharge or put your retirement on steroids. So stick around. And by the way, by the very end of this, not only that, I got a little bonus for you on this. But first of all, you got to understand what it's all about. So watch the video, stick around to the end, and I got a bonus for you. So let's talk about this. There are several types of retirement accounts out there. People get confused with the numbers, 403B, 457, 401k, SEP. You've got your IRA, self-directed IRAs, check private, all of this stuff. Those are just sections of the ERISA code, okay? So, the Labor Department put this whole thing together back in I think it was 74. Somebody can fact check me on that. I can't remember the exact date on it. But they went ahead and looked at this and said, hey, we need a different retirement system besides just Social Security. Because Social Security is not going to be enough. Nobody can retire on Social Security. So one of the more popular ones is the 401k. And that's mostly what we'll be talking about today. If you set up a private retirement account using a 401k, there are some parameters that you have to have. So a 401k is a qualified plan. So let's just address that a little bit. What is a non-qualified plan versus a qualified plan? And, look at layman's term, the very simplest way to do this is anybody can walk into a bank and open up an IRA. Now, they call it self-directed as long as it's something they offer, like that bank or Fidelity or whatever the case is. They'll say, we can open but self-directed, and you can self-direct it into anything that we have here. I don't have to work for a company. There's certain dollar amounts every year. I'm not going to get into that dollar amount. That's not what this video is about. I'm just going to talk about the fact of the difference. Okay, that's a non-qualified plan. Okay, the challenge with that is they're administrating it. When I look at a qualified plan, a 401k is a qualified plan. So in other words, I can't just walk into Apple or Ford Motor Company and go, love your retirement plan. I want to participate in it. And they're like, but you don't work here. So I want to participate in it. It doesn't matter. You have to qualify in order to do this. And then we've worked at a company. They said, hey, we've got a 401k. You're like, yeah, great. I want to put some, no. You have to meet in certain criteria. Been here for a certain amount of time. Then you can add this much. And once you've been there longer, we're going to match all of that stuff. That's where the confusion starts coming in. So non-qualified IRA, we're not going to be talking about here today. I'm not going to talk about a qualified plan, which means you're going to open up your own private retirement account, which means, okay, you're going to have most of you are going to do what we call a 401k. Anybody can have your own private 401k, and I'm not going to get into the criteria around that. We'll save that to the very end. I'm going to talk about the benefits of having this. So if I'm just a single guy, my name is Bill. I'll call myself Bill, and I want to start doing real estate in my retirement account. I can open up my own private 401k. I can sponsor it with my company, my LLC or my C Corp or S Corp, whatever is appropriate for you. It says, I would like to have a retirement account for my great employees, me. Oh, thank you very much. Okay, thank you. I'm going to open up a 401k. So I open up a 401k. Now I can start contributing to that. Okay, and I'm not going to get into all the numbers, and there's two things, age and income. The more money I make, the more I can put in. The older I get, the more I can put in. So there's criteria for that. So now that I've got my own private retirement account, here's the great thing about it. I can literally fund this a lot more, okay? Because the non-qualified plan, I'm capped out, like below $10,000. It's not that much. Here, I'm a single guy, right? If I'm over 55, I can put up to, over $56,000 or more, depending on catch-up contributions and all that good stuff. So there's a lot more money I can put. If I'm married, I mean, it gets well over $120,000 a year. And when I contribute that money, it reduces my tax liability. Pretty cool. So let's just use a round number. Let's say I'm able to put $50,000. Now, I can't just put $50,000 in there. My business, my company, I'm the president. Oh, you've been doing a really good job. Yeah, we've got some profits, so we're gonna put some money into your retirement. Oh, thank you very much. Oh, you're welcome. Oh, I want to contribute to that too. So there's two different accounts that go in there. I have a contribution, the company has a contribution. Again, I'm not going to get into those numbers because I don't want to defeat the purpose of what we're talking about. Now that I've got that money in there and I've got that account, because it's my plan and I'm the administrator and the trustee, I decide I'm going to allow this thing to invest in retirement or into real estate. Oh my gosh, that's so cool. So I take that money and I go out and buy a piece of real estate. Let's talk about tax deeds. So an example would be, let's just keep it really simple. I buy a piece of property for $48,000, or it's 50. Let's keep it simple math. I'm thinking about a deal I did. But let's say $50,000. Okay, I fix up that property. Okay, say it cost me, I don't know, another $50,000 to fix up. So now I've got $100,000 into that property. It's in my retirement account. It's owned by my retirement account. And I turn around and sell that property for $250,000, okay? All inside my retirement account. I didn't take money out. I didn't take money out to buy the piece of real estate. The piece of real estate is owned by my retirement account. And I'll get into more of that in other videos. So now that I've got all of that, I just made a $150,000, if I sold it, I'm gonna sell it. So we sell the property, all of that money goes back in there, and so my original amount of $100,000 turns into $250,000, boom, on one deal. This is turbocharging your retirement. Let's say that I am over 55 and I've retired from United Airlines or whatever the case is, something, anyways, and I retire, I open up my own private retirement account, and then I take my retirement money from over there and I roll it over into my private retirement. Now I've got a big chunk of cash in here, and I start buying some real estate. Let's say I've got 3 or 4 pieces of real estate in there, okay? And not only do it's all owned in my retirement account, but all the rent checks are coming into the retirement account. What's happening to the value of that real estate? It's going up. I've got income coming from in there, okay? And then another deal comes along and I want to do it. I can actually borrow money, not from my retirement account, but from the bank, using one of my pieces of real estate as the collateral for that loan. And any profits from that deal go back into my retirement account, and I'm not allowed to pay any taxes on it. It's like illegal to pay taxes on the profit. So, I mean, there's a lot of information I'm going in there, but that's how you turbocharge and amplify your retirement account using real estate. So let's just keep it simple. If you open up a private retirement account, see, look, you can go to Invest Trust and all these, but they're administrators. And they'll allow you to do this, but they're going to charge you money. If I self-administrate my own plan, which all it means is I've got to file some forms with the IRS, and if you're allergic to that stuff, then don't do this. Yeah, you've got to do some filings and the 5,500 forms, and I'm not going to get into that here. Here's the great thing about it. Once you start doing that, all of those profits within your real estate, guess what? They're going into your retirement account. So now you've taken a 50 or 40 or $10,000 contribution, and you've just multiplied that over and over and over again. And every single deal you're looking at, you should be saying, should I be doing this in my retirement account, or is this going to be outside the retirement account? And then you'll know how you can turbocharge your retirement account by doing that. Now listen, there is a ton of information on this. If you would like more information on this, I've got a little bonus for you. All you have to do is hit the link down below. Hit that link. It'll drop you into a page where 2 things can happen. You can watch a video on this, it'll go into great detail, or set an appointment, and we'll have somebody talk to you exactly how you can set these up, okay? A lot of information, a great way to provide financial independence for you and your family. This is Saen Higgins saying God bless and good luck. We'll see you out there.